Hi, I'm Lorian Larocco, and joining me now is Charles Steene. He is president of Maersk North America. Charles, thank you so much for joining us. First and foremost, the company reported earlier last week as it relates to earnings. But let's dive deep into North America, which of course is your bailiwick. From logistics and services, they saw significant growth in volumes. Margins, as the company said, were unsatisfactory at a level due to low utilization in terms of some of the warehousing and the short-term challenges. Can you kind of dive into that a little bit more in detail?
Absolutely, and thanks for having me, Laurie. Happy to be back with you again. Yes, you're right. You would have seen when Vincent spoke to our numbers last week, the call out on our logistics and services was made in relation to specifically the margins, and then specifically within North America, the margins in what we refer to as our Maersk ground freight services. The short and the long story effectively is one that is anchored to the bigger message, and that's one of growth. So when we, within North America, our last 4 years, of course, expanded our organization, acquiring additional services, additional skills, additional infrastructure, we also created the pathway to drive growth into more landside connected services bolted onto our ocean. What we've seen at the back end of last year, 2023, the growth within those services was material to such a level that we had to admit that by the time we got into the full peak season of Q4, the growth was such that we came to a 30 to 35% growth month on month, which, as you would have heard last week, really meant that that level of growth was almost too much for the organization to absorb without at the same time having to make some trade-offs in relation to what it would mean to our margins, ensuring that we would keep the service levels to our customers high, which meant that we simply spoken needed to spend more money to ensure continuity for our customers and at the same time build the infrastructure to service what was going to be a significantly larger organizational landscape in terms of volumes than we had anticipated to begin with.
What does it look like in terms of those ground logistics? I'm hearing that a lot of shippers are using rail over trucking as of right now, particularly from the West Coast to the East Coast, as we've seen, some diversions going over to the West Coast. What are you seeing in terms of growth rail between rail and trucking?
Laurie, we don't really see a very pronounced different trajectory than what we would have seen in the previous quarters or years. We do see, and we've spoken about this also when we met a little bit earlier in the year, we do see some diversion taking place in the sense that some of our shippers have decided to take percentages of their overall flows into North America from the East Coast into the West Coast, which has led to indeed a small increase of the rail activity simply because that still continues to be the most cost-efficient way to get your flows from the West Coast towards the East Coast. But the way we look at least, it has not been a material shift, and we also don't see it to be a structural shift. It's probably more situational than anything else.
No worries. And how are things going with Mexico as it relates to the buildup there, your investment there, as well as the anticipation of more imports coming in?
Yeah, quite well. Actually, I'm happy to say. So the month-on-month growth into the Mexican port, in our case, that's Lázaro, continues, is basically on what is today, for us at least, a journey of 7 consecutive months of growth. And we also see that the growth actually has a slightly different composition than it would have had a year ago, where we do see more flows now moving to Mexico that ultimately have a destination that is within the US, as opposed to a destination that was going to be just for Mexico. So we see a slight shift in terms of how our network, our vessels into Lázaro are ultimately composed between US destination and Mexico destination. And then we see on the back of what is a month-to-month growth, the potential for this to, at least by our estimations, to continue for what is the rest of year until the end of year. So quite good, actually.
And the origin of those containers, where are they coming from?
Asia. And then Asia is, of course, a broad area, but in most of the case, the usual strongholds of Asian origin. So that would still be, of course, China, but includes also quite a bit of Southeast Asia, Vietnam being the most prominent one.
And then when it comes to the transloading of the containers, how are they getting over here to the United States?
I normally call out two quite different flows or quite different streams. One, very traditional. You just touched upon it for the regular rail connection in the US. So one is traditional, in which we basically move the containers through a rail connection into Texas, and in some cases all the way up to the Midwest, which really means nothing more, but also nothing less than a regular flow, as and when it would be entering through Prince Rupert in Canada or through LA Long Beach in the US and make its way to an inland location. So that's move number one, in which we take the container, of course, onto our terminal, put it onto rail, and then move it to its final destination in the US, including everything that comes with it. So that's flow number one, which is, because of what is now available on the rail side, a easier path than it would have been a little bit over a year and a half ago. But it's also a path where more customers are eager to bolt that into their supply chain planning as one of the alleys that they would take to get their goods into North America, and then specifically the US. If you then look at the second flow, that actually is more prone to what we call our fulfillment customers. So those customers that do not necessarily need their flows all the way into the US, Midwest, or Texas, if you will, but want to feed their fulfillment centers in Mexico, and from there feed into the North American market using a last mile service component, either pure truck or by parcel delivery. And as a result, actually have their fulfillment footprint for the US now no longer based in the US, but based out of Mexico, which then means that we also bring the containers into Lazaro, bring them into the facility, which could be in different locations across the border of Mexico and the US, and induct them into our fulfillment footprint, and from there feed into the final mile anywhere in the US.
Out of all the different tentacles that the company has, and we've talked about this before, you're more than an ocean carrier. And clearly with this discussion, investors out there, should be aware at this point. When we're talking about investment, where are you guys beefing up, particularly when it comes to Mexico? Because it's, that's still in its infancy, right? Compared to the more mature areas within North America that you're operating in. Where are you spending your investment dollars, so to speak, in anticipation of stronger trade going into Mexico and then into the United States?
I would say three things stand out in terms of the most dominant pillars of investment in Mexico. We spoke about one of them previously, and that clearly is our terminal operations. In anticipation of what we expect to be a continued growth, also in need for additional value-added services in the terminal, that's clearly the initial bucket, not new. Initially started already back roughly in 2021, but continues to be a focal area simply because of the longer-term impact that investments in a terminal complex will always have. But that, without a doubt, will continue. The second, touched upon it just now, that really is in this fulfillment space where there's a pretty large need and ask for continued capacity along the border of North America and Mexico for pure fulfillment capacity, not just in buildings, but also in skills that come with it. So what we will see, if you now take 2023 start of year, until end of year 2024 is what will be a fivefold increase of our footprint. And bearing with me, that was a small footprint at the beginning of 2023, but will be a quite sizable one at the end of this year. And we expect that to also continue next year. So that sits in additional buildings, additional campus buildings that will help us provide fulfillment capabilities into the US market. Then the third one is a little bit connected, but I would say very passionate on my agenda, because I think it's one that normally gets or stays under the radar, is the cross-border trucking space, or the cross-border landside space, where many of our customers have indicated that within their international supply chain, the ability to run what they would call as a fluid operation between Mexico and North America is heavily contingent on the complexity, or the ability to manage the complexity of cross-border operations, which on one side is the actual trucking capacity, trucking quality, but on the other side, the availability of transload locations on the border that allow you to navigate between what are two different markets in terms of capacity play, trucking environment, etc. So our ability, now back to the point of not just being this ocean provider, to within that bigger scope of the global supply chain, allow our customers to bring their flows into Mexico, but then also integrate them with flows of manufacturing in Mexico, which clearly are increasing, plays into this third pillar, which then sits on strategic investments in capacity, road capacity, and strategic investments in pure transload locations across the border.
What kind of volumes are you anticipating in the next year or two when it comes to that?
Yeah, we're at this stage, if you look at the volume in this space, you look at trucking volume. So we look at moves that are not so much shipments, but moves. And we look at, well, anywhere between 50 to 100,000 moves of pure increase, which is roughly, I would say, for us at least, a 10 to 15% increase.
You know, we're talking about, you know, strength and trade routes. Out of all the routes that you service for North America or bound for North America, where do you see the most growth, and what has you most excited?
And Laurie, you then mean in terms of flows, international flows from the ocean side?
Yes.
I'm going to give you a very broad answer because the excitement is across the board. We are, and I think this is the oddity of what 2024 holds for us. We had named and labeled 2023 the year of normalization, and we are labeling 2024 as the year of reinvigoration. And that really is mostly driven by the fact that the growth of flows into North America, and then specifically the US, is outstripping any previous expectation. And where, of course, based upon last year, we would have expected some level of regression to the mean, if you will. So pre-2019 normalized flows and growth. But in fairness, all since the beginning of the year, the actual overall growth out of Asia and out of Europe into the US has superseded any of our expectations.
What do you think is driving that?
That's a very good question. Well, the one thing that is driving it by pure metrics seems to be the US consumer. The US consumer and their spend into goods continues at a level where most analysts, including our own, but certainly also external ones, had predicted that to taper off, and for the spend on services to increase, to somehow get back to a somewhat normalized pairing between these two, once more pre-COVID. What we are somewhat, I guess, taken aback by is that the strength of the spend on goods as opposed to services continues at a very high pace. So the one thing that sits behind it clearly is the US consumer. What sits behind that right now, the only way we can look at it is the continued spend on goods as opposed to services. The key question for all of us will be, Does that strength continue also as we go into the second half of the year next year, or will that at some stage indeed somewhat taper off? Right now, there's no sign, at least not in the foreseeable future, for that to taper off.
What does peak season look like for you? Because that's in theory the second half.
Yeah, we're getting very close to that, Laurie. Give it another 5 to 6 weeks and we're in it. We are predicting a normal peak season. So we are predicting a normal imbalance in terms of how much the first part of the year and the second part of the year will produce. And right now, there's nothing that indicates that it would be a slower peak season or a bigger peak season. We believe a normalized peak season, which on balance, would indicate that anywhere between 4 and 7%. And depending on the industry, that can be more skewed. Of course, retail is more skewed than others, sits in that latter half of the year.
And are you looking at peak season starting in June or July?
June. We would normally always see the first indications in June, the first real big campaigns for some of our customers, specifically those that are exposed to back to school and everything that comes with it. That already starts in June.
And how is the threat of a longshoreman strike on the East Coast impacting any type of impacting any type of imports coming into the East Coast? Are you going to see more volumes coming in June versus, say, July?
That's not what we see at this stage, Laurie. The only and quite subtle change that we've seen is the one we've touched upon a few minutes back, is we do see some recalibration towards the West Coast in mitigation of risk, but we haven't seen, and I'm assuming that's what you're alluding to, any pull forward of flows into the East Coast to be ahead of what could potentially be a disruption. So the only small nuance that we see, a little bit more over the West Coast, but also that is not extremely pronounced.
Let's turn to the Port of Baltimore. Would love to get an update from you as it relates to the services that you guys are doing right now for the clients that have containers on the dolly, and as well as your outlook, if you will, in terms of the timetable. It is very fluid, so that's understandable, but what can you tell us in terms of what you're seeing as of right now?
Yeah, so let me confirm, it is indeed extremely fluid, and of course it's a horrible tragedy when we look at what actually has been at the core of this and how it happened. From a pure practical point of view, and when we look at the customers and their shipments that are in play, we've seen 200, a little bit less than 200 containers taken off the Dali in the course of the last 9 days. At this stage, there is no immediate planning to take more off the Dali, and that's almost entirely linked to the ability to float it and make sure that we can actually get it into the port. We, at this stage, have helped our customers both to create mitigating solutions through either Norfolk or Newark, both over the road or through shuttle. And we're in the midst of planning what should be a complete resuscitation of our service towards and from Baltimore. At this stage, planning, as you probably also have seen, is for the channel to be open again for sizable vessels by the end of May. And our current planning will see in the next 5 to 10 days our network team to then, based upon how the progress continues, be able to re-include Baltimore as a full-blown component within our network for end of May, starting June. And really there, the only ambiguity or the only uncertainty is the cleanup activities and as of when we think the channel will be open.
It's amazing how quick, I don't think people realize how quick and nimble you have to be in order to strategize. I mean, 5 to 10 days when you're moving these behemoths on the water, there's a lot that goes into that type of planning. Can you kind of dive in and kind of give, without secrets to the sauce, of course, can you kind of explain of what kind of factors and planning that goes into the reallocation of putting that port back into service for you?
Yeah, and you're right. I'm not sure if it's a secret sauce, but it certainly is a sauce that takes a lot of effort within the organization to pull off. To a certain degree, we've been, I would say, blessed in quotation marks, because you can't really speak about that, by the fact that we were already forced, as a result of the Red Sea situation, to really take a super deep look at our network at the beginning of January, end of December, where the unfortunate developments there, of course, forced us to take a really deep look at our global network and how the rerouting around the Cape needed to somehow both bring in additional capacity, but also additional timelines to still keep the network whole. That activity, by and large, has been the same here for Baltimore. So a lot of what the teams would do as these situations happen is almost a multi-channel calculation of how the impact of one port omission now feeds into the cascading effect across what are the adjacent terminals, the adjacent ports, and then how that cascades back all the way into the global network. What does it mean for some of our vessels calling upon Indian ports with a destination for Baltimore? How do we now make sure that that cargo actually makes its way to Baltimore throughout a Norfolk or Newark? So normalized, in a normalized environment, this process would take between 5 and 7 months to really take place in a structural and ultimately long-term fashion when you reset your network. What we've now been faced with, back in January, we had to take anywhere between 3 to 5 weeks, as opposed to that longer period, to pull it off for the global network. In the case of Baltimore, we had to take 3 to 5 days to do the same. So a lot of things have to come together. We've, in 2024, of course, had the experience as to what it meant at the beginning of the year, that we could deploy and be more agile at the end of what was ultimately the month of March, April.
The Houthis have recently announced that, they're expanding their attacks into the Indian Ocean and the Arabian Sea. It's lengthened the journey for the vessels. How much additional time is that impacting the North American freight? We all know, of course, that it's the European shippers that are being more heavily impacted. But what about here as it relates to this expansion threat from the Houthis?
Difficult to say at this stage, Laurie. I think the time, so the transit time, probably will not be impacted more than it has already been impacted. So you're looking at maybe 2 to 3 weeks, depending on the normal routing of the original vessels. It probably sits more in the uncertainty of whether or not what by now has been a pretty stable embedment of the new network. It's our new normal, for lack of a better term, where, of course, some of the disruptions that we've seen and the widening of the scope of potential attack might potentially lead to temporary longer routings that will go still around the Cape, but just have an impact of anywhere between 1 and 2 days. So the big impact in terms of timing we would already have seen, barring, of course, a severe escalation even further than what it has already done right now.
The company announced last week that they're leasing more than 125,000 additional containers as a result of the Red Sea. How many of those containers are for Europe, and how many approximately would be for any North American freight?
Yeah, that's difficult to say. You would have to look at this from a global network perspective, because containers are flowed throughout the entire network. So that number is crucial for our ability to keep our network fluid and to continue to have an ability to pick up cargo at origin, whether that origin is in Asia, whether the origin is in the Middle East, Europe, or the US, or the other way around. Doesn't really matter. It really should be seen as an influx into the big pool of containers that allow us to keep the global network fluid.
And finally, we saw the return of some of the surcharges, just because, as you've pointed out, the longer transit time, the fuel costs. When it comes to the cost of the container, the price of containers has gone up marginally. What kind of transitory inflationary headwinds are you seeing as we head into peak season, and if we might anticipate some additional charges or increases as a result of all of this uncertainty?
And then you mean in particular just to the broader ocean freight environment? I
Yes.
think a lot of what we see as potential inflationary development is what you would have heard already last week. It sits on three main components. One is clearly the considerably higher bunker costs, so the fuel costs, and not just because of us utilizing more, but also the actual fuel costs themselves because of what has happened geopolitically has gone up. That is a significant part that will drive costs up, which ultimately you will most likely see translated into rates. Two is the capacity needs for the feed into what is now the longer transit time for almost every carrier out there is built upon bringing in additional vessels. For some carriers, it might mean rerouting some of their vessels from other trades. For most, it will actually mean bringing in chartered vessels, so additional capacity from the market, which, as you might have seen in the market itself, have significantly increased in terms of their daily rates. So you'll see a need to bring in more capacity, as a peak season will also bring the total volumes up. Transit times continue to be prolonged, and as a result, you'll see a capacity need that will still be there. And right now, you would have heard global capacity has been absorbed for anywhere between 6 to 8%. And that will probably be higher when you just think about what it means for Europe. So that capacity part is the second most dominant part. And then, of course, thirdly, which is linked to the second, you'll see for those carriers that need to reroute some of their capacity to where they need it the most, they will have to reroute it from some of their trades. And the opportunity costs that sit within that trade will, of course, ultimately feed into a need to recover some higher cost on those trades.
And what's your outlook for here in North America? Do you feel comfortable in terms of the capacity of what you're foreseeing with the potential orders coming in for peak season, and just what's going on right now with the jockeying, if you will, right, of capacity because of the Red Sea and all the other headwinds?
Yeah, I would tell you what I tell most of our customers. The way things look today, capacity is going to be a challenge across the board in the industry, including for North America. North America, we spoke about it last time, as on one side, the impact, the network effect, if you will, of the Red Sea, maybe not as close to the impact as a Europe would be, but the network effect is significant. And then, of course, within that network effect, the effect for the East Coast on the reduced throughput of the Panama Canal, combined with the overarching growth that a peak season would bring along. So our recommendation is for all of our shippers, regardless of their industry, to stay close to the market, to make sure they stay close to their strategic partners, and make sure they stay as close as they can to their forecast of volumes, because our prediction is that capacity will be a challenge. Based upon what we can see happening in the Red Sea, there's no immediate expectation that will settle down, unfortunately, which means that this is going to be in for some disruption for some time to come.
When you talk about capacity and the tightness, can you quantify like a ballpark of how tight it could get?
So that's back to the 6 to 8% that is sucked up in the actual overall flow.
Right, wonderful. Charles Steene, president of Maersk North America, thank you so much for joining us on State of Freight.